I'm going to show you why there's a real case to be made that the US economy is already in a recession right now. Not next quarter, not next year, but now. The data's quietly rolled over. Most people aren't looking at it, but when you see what's under the surface, it's hard to ignore. Let's dive into this. Now, we had David Rosenberg on Macro Voices just earlier this week. We'll share what he said throughout the interview. What I have here is that chart of the final GDP quarter over quarter that was just released on Thursday, June 26th, and it came at minus 50 basis points. But here's the key: we haven't seen a negative GDP quarter like this in a very long time. You have to go back to the 2022 contraction period where we had a stock market bear market. And so we have now got the first quarter in place. If there are two back-to-back negative quarters, that becomes the case for a recession. And so here we are, one quarter out of two that's already turned negative. Now, what I want to talk about here is the National Bureau of Economic Research. Now, this is the bureau that comes out and studies all of the prior business cycles. And they go all the way back to 1857 and studied every contraction and expansion cycle out there. And so the last time that we had an official recession was through COVID, started February 2020 through April 2020. It was essentially a 2-quarter contraction before the new expansion started. Even 2022 wasn't officially a recession. And so we have a scenario now where we're starting to see some cracks in the armor. And David Rosenberg was just talking about that during that interview. So I want to take a look at this ISM manufacturing PMIs. They're not as important as the service PMIs, but they are still a key component of the US economy. We have now seen 3 months of contraction in a row with these numbers coming in under the 50 level. Now, we have had several years of negative manufacturing, and that has obviously been an issue with the current administration and their desire to bring manufacturing back into the United States. But point here is we continue to see contraction. But now let's move on to the ISM services PMIs, which came out earlier this month on June 4th. And this predominantly stays above 50. The services sector of the US is the stronger and much larger component of the economy. And what we can identify is throughout the last 7-8 months, not only has it been continuously weakening, but this past month, we have now seen a negative print under 50, which is a contraction phase. We haven't seen this on a consistent basis since COVID, and there was a temporary one in 2022. Now, again, one negative print like this isn't enough to actually qualify a recession, but the negative data compiling this way is exactly what David Rosenberg was talking about in his call, that the recession risks today are much greater than they were 3 years ago. So another topic which is going to be hot here in the next few weeks is what's going to happen during the July earnings cycle. And one of the things that we have seen over the last few months during this rally is that this has been an expansion of the multiples that are in the stock market. And therefore, we're just simply paying more and more for the same earnings. Now, many people are hanging on the fact that with the Fed inevitably starting some further easing and this great, beautiful bill being released, that the stimulus will allow everything to just re-resume and corporate earnings growth will continue. But what you can observe here, when we look at the 12-month trailing earnings per share, the orange line, it's been very flat for the last couple of quarters. At the same time, the S&P 500 has been rising. Now, if you observe, there are numerous cycles where we see corporate earnings contractions, periods where the earnings decline. And that's where the orange lines are dropping. This is usually associated with some sort of a bear market as the stocks start to price in these types of recession risks. The question here is this flatness of the current earnings, a warning sign that earnings may begin contracting? And does June mark the window where we start seeing forward guidance by many of these companies start to actually indicate that things are weakening in this period? There's a lot of uncertainty with tariffs and other things that have caused many of these businesses to hold off on major projects until there becomes clarity on how things are going to play out. This is an area where the stock market is really right now hoping and pricing in the best case scenarios. And if it doesn't come in line with that, there's a lot of risks to the stock market. So listen, all I did was just show you some of the data and facts that are out there in the market right now. But let's hear from a famed economist, David Rosenberg, on what he said about where he thinks the economy is right now.
The tea leaves are right in front of me. And in fact, I have more conviction in the recession call now than I did 3 years ago. And in fact, there's some measures suggesting that the economy is already in a recession. And let me just tell you that we do receive monthly GDP data, and GDP in the United States, real GDP, when you look at the monthly data, which can sometimes get lost in the quarterly averages, real GDP is running slightly negative on a 3 month and 6 month basis. April over April of last year, real GDP is 1.3%. The market doesn't see it. Real GDP is slightly positive year on year, but the 3 and 6 month trends are showing that that 1.3 is actually subsiding and the economy is actually contracting. But you see, then you have Jay Powell telling everybody that the economy is solid. And I guess that the world will listen to Jay Powell over David Rosenberg. And when you have the central bank chairman saying things are solid, well, the economy is solid. The economy is solid. Inflation is going to melt away. The Fed's going to cut rates. No tariff war, no Mideast war, big, beautiful bill, all the stimulus, and you're off to the races.
I believe Rosie is spot on in many ways. The data does continue to deteriorate. And he references specifically how Powell is saying the economy is fine. But I want to reference one chart right here. And this is the Fed tightening cycles and financial events. And this is to support the case that's often been referenced, which is that the Fed stays tight for too long until something breaks, and then they have to rapidly cut interest rates in order to re-stimulate the economy. What you can see here are those bars that reflect all of the recessions that have happened since the 1970s, and each one marked with a financial event that actually happened during the rate hike cycle and or a high interest rate period. And so what all of these crises have happened, and is this going to repeat itself again? Or is the Fed going to stay too tight, too optimistic for too long, and something in the financial plumbing breaks and ultimately forces the Fed to cut interest rates much more rapidly than the current market is pricing in? So if David Rosenberg's right and this data continues to deteriorate, it's going to show up in the market's pricing sooner or later. This is a time to think about defense, low beta sectors, cash flow rich businesses, maybe long bonds. And if you're tactical, hedge with options. You don't need to panic, but you do need to pay attention. Watch the data, not the headlines. If you want to see how I'm navigating these markets, click on the bigpicturetrading.com link below for a free trial.